Right, good evening, guys. Uh, this is Ken at Tortoise Capital. This is the book club check-in for February 21st, 2024. Just a quick check-in to see where we're at. We have session 7 tonight. We're looking at pages 191 to 233. So we're in the middle portion of the book, which is really a collection of many individual topics. These tend to be self-contained concepts that can apply to a variety of trading systems at the strategic, operational, or tactical level, or the core, the swing, or the day trading. They deal across the phases of plan, prepare, execute, and assess. And they're really designed to help you find ways to improve all of your processes continuously. So there's these are separate tools that are appropriate at different parts of your journey. You know, based on your assessment of what it is you need, you may find all, some, or none of these to be directly useful or not. But they're really a collection of things that have worked for us over the decades and applied to multiple people, and that the community of practice found to be helpful. And so it was really, this is the part of tens in the middle of the book where we're adding goodies into the basket, if I can say it that way. This comes after we've gone through, you know, the top-down introduction to ourselves and the book, a review of challenges, references, and inspirations, some top-level mental models and processes, a couple quick looks and deep dives into specific strategies like the sniper, the Kata 2 challenge, and the idea of the 2R battle drill as a way to sharpen your focus on successful trades. And then last week, we took a look at a infrastructure support package, the Tortoise trading tools that Phil has put together for Thinkorswim, which we have for TC2000. We have for Trading View. We have it for TradeStation and dashboarding in Excel. And this was really the decision support system ideas that make it easier for you to make systematic and disciplined decisions. So we're now into the pieces and parts that can be plugged in like modules to supercharge your trading. We'll do that for the next 3 weeks, this week and the next 2. And then when we get into the middle of March, we're going to be taking a look at how 10 specific traders have taken this body of knowledge and applied it to their own professional style trading. Now, a number of those guys are professionals that trade on the side. Some of them are beginning or intermediate level traders that are looking to expand their skills. Some of them are professional money managers and have been professional for decades. And so the point of that is to say that all of these pieces and parts that we're going to go over for the next 3 weeks are things that have been broadly useful to that wide range of traders looking to increase their professionalism. So we're going to equip you with what we think are 10 typical ways that you might proceed with trying these ideas on for size. And then in section 14 or session 11 on the 20th, you will have had a chance to look at what other traders are doing, and we will answer questions in here, and really in the session 12 as well. That's your chance to ask final questions that we can help you tailor material to your own particular use. So that's the roadmap for the pathway ahead. And having said that, we'll move on to tonight's material. And thanks as always to Griff for putting together a terrific set of worksheets. And let's see. Here's what I want to do. Yeah, we'll start with just the broad overview. So this is session 7, pages 191 to 233. It's section 12 in the book. And this is part 1 of mastering the trades. The top level quote to guide us comes from Ernie, who says, remember that this book is the beginning of your trading adventure. You have not yet been introduced to the menagerie of frogs, monkeys, owls, and other creatures. These are totem animals for us, shamanistic power animals that represent psychological states that give us the ability to remain clearly focused on the trading tasks at hand. There's certain behaviors of frogs that are appropriate for a certain style of trading. And the same with monkeys, owls, and other creatures that we use. And Ernie also advises us that you still have music to hear, poems to read, battles to be refought. And yes, all of these relate to being a trader. And this comes from the Creativity 202 course that Ernie has been through twice. And these are elements of total accelerated learning that we use to help us activate important parts of our brain to more easily adapt the techniques of professional trading. So understanding how music and poetry and reviewing historical battles and leaders all give us insights into the challenges of trading in certain mindsets. And so those are all part of the journey that we undertake in foundations and in creativity coursework. I do want to start over here on the self, and I want to acknowledge the important work and contributions and the courtesy of Jeff S. and Ernie S. Now, these are 2 additional traders. They did not get put into section 13 because they were their contributions came in after we had already written that section. But I thought what they had to say spoke directly to newer traders. And so we wanted to include them in their own special section. When we take a look at the other 10 traders, exemplar traders, I'm describing what their general strategies are and how it might fit you. But in this section, the testimony of Jeff and Ernie really are more about their own personal journey. And I thought what was really important that Jeff talked about was that he is actually a very experienced trader for many years, but he never kept a trade journal. He always thought it was too much work. And when he made the commitment to keep a journal, he found that suddenly he actually had all the information that he needed to conduct a thorough statistical analysis of his trades. And what made that breakthrough really interesting and almost ironic to me was that Jeff is a maintenance test pilot for the state of Texas, and he's the senior pilot for their fleet of firefighting fixed-wing aircraft. These are the guys that fly into fires and drop the fire retardant chemicals. And so as the maintenance test pilot, he's responsible for the equipment and the readiness of all those pilots for that high-risk profession. At the same time, he was also a trader. And while in his professional capacity as a pilot, he was accustomed to doing a lot of work and making commitments and statistics. And the things that he was willing to do for flying, he hadn't really crossed over to bring that into his trading. And one of the important breakthroughs that he made when he went through the foundations course and the creativity course was the ability to see the connection between what made him successful as a pilot and a leader, and the skills that he needed to apply for his own trading. We were able to kind of break down that separation and realize that he had a common framework of professional behavior that he demanded of himself. And if he could do that for flying, he could bring that same mindset into trading, and it immediately improved his trading overall. And so I actually included his presentation for our annual research project from this past November. I put that as an extra piece of research for you to listen to in the online workshop version of this course, because I think it's just such a powerful piece of testimony. So I would encourage you to listen to that if you haven't listened to it yet. And then Ernie's trader's profile was, here's a wonderful retired gentleman in his 70s that had been dabbling with trading for years and decades. And he raised his bar and learned how to accommodate drinking from the fire hose with all our new information. And he ended up joining an accountability group with some reluctance. You know, he was a guy that preferred to work on his own, and I think that was he felt, I think, that he didn't want to inflict his trading on other people or distract them with his own humble trading. But the breakthrough that we had there with Ernie was the recognition that it takes real courage to represent your trading in public with others. It's an act of courage. And that the learning that you go through when you're in public like that not only is a powerful lesson for yourself, overcoming maybe fear and reluctance and finding sources of courage to speak in public about your own work, but it was also resonating with all the other guys who ended up also having a lot of the same challenges, but who were also reluctant to share. And so when Ernie demonstrated some leadership and established an accountability group and was able to share his learning in public, it actually was a tremendous example to others. And the powerful accountability group that they have put together on their own has been really beneficial to everybody that's joined. And so what I thought was really an important systematic note was the idea that all of these guys, although they are trading in different ways and have different backgrounds, are using a common system of journaling and accountability, and I would also say coaching, learning to develop their own coaching eye, which I talked about in the previous section, and that this was really the key element of their own breakthrough. So Jeff's story and Ernie's stories are ones that I really just strongly encourage you to review and enjoy. Okay. Under the markets, since we're here, there was quite a lot of material included that was technical in nature that had to do with the many different ways that we actually go about classifying markets based on different periods of time. The central idea that locks all of those things together is the idea that your market classification system, described on page 191 and 192, is that it should be specifically geared to the time frame and style of trading that you're doing, and it should have a bias towards action. In other words, simple descriptions of the market that don't give you insights into what to do aren't really useful. And if the information that you're getting is not coming to you in a timely, accurate, and complete manner so that you can act on it, well, it's really just more noise and window dressing. So it's really important that you make that a value added proposition and make sure that it is tuned to the kind of trading that you want to do. For example, if you're a long-term swing trader or a core trader, it may be that a market classification system that only adapts once a week or once a month might be appropriate, because you want to hold those positions for a couple weeks to couple months or maybe a year. And so it has to have enough buffer and thick skin so that it's not switching every other day and making you trade faster than you want to. By the same token, if you had a good market classification system like that, it might not be useful for intraday trading, where the market dynamics are tradable, but would be considered noise when looked at on weekly or monthly charts. So you want to make sure that your market classification system is really geared towards what it is that you're trying to trade. Now, I want to cover a few of those right now. So the first one that we talk about on pages 191, 192, and then into 193 really are addressing this strategy. And that is that we're looking at 9 different conditions. And so what we do is we take a look at whether it is bull, sideways, or bear, and we measure that as a function of price relative to the 200-day moving average. Now, what we've studied on that is the following, and the method that we use to research this was as follows. What I wanted to know was as we were approaching the close of the day, so intraday that price is moving towards the close, I had one big question, and that was, should I hold this position overnight and expose myself to the gap that can occur in those 17 hours while the market is closed until the market opens again? So if it closes here, there can be a lot of news that happens inside here. And so it may close here, but when they process that news, it gets interpreted as a negative, and so you get this big gap. So I can't do anything about that in typical systems unless I'm going to be an overnight trader or trade currency markets or whatever. I can't really get after that price action that's in here, and I'm held hostage by whatever those market participants are going to do and the newsmakers. So it's a really important question for swing traders and position traders is, should I hold that position overnight? And if so, what's the appropriate approach to risk management to protect myself against the gap? So if that's the case, if I was going to study that, I have to study the statistics of the gap, look at the conditions in which the market closed, determine if that influences the gap, and then assess how much risk to take. But it comes down to, really, should I hold that position overnight? So what we did was we took a look at some charts and studies where we looked at price relative to the 200-day moving average, because we knew that at the simplest level, the 200-day moving average, that if price closes north of the 200-day moving average, that is bullish for tomorrow. And if it closes below the 200-day moving average, that is bearish, all other things being equal. So when we study that, we went back 20 years and we classified each day based on where the close was above or below the 200-day moving average on that day. And then we said, for bucket number 1, if we put all the days in which it was bullish and then looked at the average gain for tomorrow, it turned out that it was positive. And if we look at all of the days where the market closed below the 200, tomorrow on average was slightly negative. So just on the basis of price relative to the 200-day moving average, I can already start answering that question. Should I hold it overnight on the long side? Yeah, maybe not, probably not. Or have a reason to hedge against it. when we were looking at those charts, one of the things that we noticed was that if you put a 2% band, plus or minus 2% band around the 200-day moving average, and then studied those days and called that sideways, even if the slope of the price was up or down, we just said if price was within 2% of that 200-day moving average, it turned out that tomorrow on average was flat because there was so much additional buying and selling pressure that the advantage of being bullish or bearish disappeared when price was very close to that 200-day moving average. So we studied a market classification that had three conditions: bull, sideways, and bear relative to the 200-day moving average. And it turned out to have an advantage when looking at the last 20 days. The next thing we did was we independently looked at volatility. And I'm not going to go into the math of this because it takes a long time and it's proprietary too, but I explain it in full in the foundations. But we found a way to classify the market so that based on volatility compared to the last 100 days, we took a look at ATR percentage of the last 14 days, and we measured the volatility of the last 14 days, and we compared it to the last 100 days. And on that basis, we said 2/3 of the time, we will classify it as normal, 1/6 of the time as volatile, 1/6 of the time as quiet. And then we organized the market into three buckets. And on the basis of that, we found out that when the market was quiet, tomorrow on average was good. When it was normal, on average, it was good. When it was volatile, on average, it was flat because you had a lot of up days, but a lot of down days too. So that was a useful, actionable market classification, just as volatility. So then we said, let's combine that and see if we could use price location and price volatility to determine which of those 9 categories was advantageous to hold overnight. So we went back 20 years, and then we classified each day as being in one of these 9 buckets, because you have to redo it. You can't just assume that bullish and normal is always good. You actually have to find all the bullish volatile, all the bullish normal, all the bullish quiet. So you end up getting 9 different buckets. And then you analyze the stats of each of those 9 buckets, 1 through 9. And when you do that, what you find is that there are 4 conditions in green, 1, 2, 3, and 4. In other words, any bull plus sideways quiet on average tomorrow is up. So there is a statistical advantage in holding a winning trade overnight if the market closes in any bull or sideways quiet today. You should hold it overnight. If you have a position and it's coming towards the close in the last 5 or 10 minutes, and you see that it's going to close in sideways volatile or sideways normal, there's no advantage. Tomorrow is equally likely to be up as down, and over the long run, it evens out. So there's no extra advantage to holding that position overnight. And then if you have any bear, whether it's volatile, normal, or quiet, any bear market on average tomorrow is down. So if you have a long trade and you're in the money and it's coming towards the close, you should probably think hard about protecting that, because tomorrow on average is down and you're going to be giving back some of that money on a close to close basis. So that turns out to be a strategy for market classification that is good for swing trading and core trading, because you can actually study the statistics and see how that works. And then on swing trading, what you can do is you can take the 7 different specific robotically tradable systems that we have, the mechanical systems, and then you can take a look and see when those systems fire, and then how did the trades from the 5-day down, 551W, channeling, overreaction, washout, and triple screen, plus the continuation patterns that I talked about in a previous session, those 6 mechanical systems plus the continuation pattern, we then study those historical trades and see how they perform in those different market classifications, and then you can decide which swing systems that you actually want to trade. It turns out that you only want to trade the channeling system in those, because in the channeling system, price is better than the 200-day moving average, and you've had a pullback to an oversold condition, and you want to buy the close or tomorrow's open and hold it expecting a rebound. And it turns out that's a good strategy in channeling when you are in one of these conditions. And because the rule requires price to be greater than the 200-day moving average, you can see that we've actually built the insight from the market condition into one of the setup rules. And now we take each of those swing trades, the systems, and we map it to each of these market classifications. And then we can make decisions on what's the priority for taking signals when you have multiple alerts. And should you stop and reverse, or should you take the failure trade, or should you not trade it? So we've done that work in our swing trading system, and it turns out that this is, if you've got mechanical systems, this is absolutely the kind of research that you want to do that's going to improve dramatically the performance of your swing trade or long-term systems. So we can tell you that much for sure, no matter how you trade. The next thing that we have studied in time is the idea of the weekly RSI 14. So if you are on weekly charts, this is just a tip, and it's described on pages 192 and 193, all other things being equal. It turns out that it is very hard for weekly RSI 14, which is scaled between 0 and 100, and the default positions on it are 30 and 70 for oversold and overbought. When you take the 14-week RSI, the weekly RSI 14, it is a rare condition for that indicator to move into an oversold condition. Let me try that with a slightly better, if that indicator was, and so what we tell you that you should do is, whenever you notice the weekly RSI goes below 30, you should put yourself on alert, because you just identified the beginning of an extraordinarily unusual, large, broad sell-off in the market. This is especially true if you're looking at SPY and a big index like IWM. And then the alert to get long is if that thing improves and then comes back above 30. So what you want to do is alert on RSI less than 30, and then when it crosses back above, chances are you have seen an extraordinary sell-off, and when you look at a chart, it will be unambiguous. You will have seen price get into a cascading sell-off, and then enough of a recovery so that RSI 14 gets back above 30, and you'll be able to get in at a reasonable level and still have enough reward for a return to previous highs with a manageable risk that gives you a favorable reward to risk ratio. That is a very good tip for how to trade broad, liquid, global markets for equities. things like Japan, Brazil, Mexico, Europe, Asia, the US. That is a terrific hint for you. Now, the next thing that we're going to do is we're going to talk about this idea of a market mosaic and give a hat tip to Robert Gardner, rest in peace. And what Robert Gardner advocated after a 40-year career of professional money management for institutional clients and high net worth people, he was of the opinion that, like any high reliability organization, you should not oversimplify. And what he liked to do was take a look at the broad market itself and realize that you could assemble insights from these different kinds of indicators. And each of those little pieces might give you an insight into the overall market condition for where it was excellent. And if you started accumulating these independent studies, like this one might be looking at the market in that dimension, and you bring in that reading, and then this indicator tells you something and you bring it into here, you could start piecing that together and start realizing that maybe you had this many indicators that were flashing green, and then you might have some number that were yellow, and then you might have some number that are red, and that when you studied those things in aggregate, you could begin to assemble a larger picture, what he liked to call the market mosaic, and then some subtle, longer-term, fundamental truths might begin to emerge about the conditions of the market that would give you some insights about where to trade. One of the standard approaches that we use when we are assembling this market mosaic, which we study on a weekly and daily basis in our reports, is that we use a standard configuration of traffic lighting with 4 condition codes: green, white, yellow, and red. And the general idea that we're going to use on that looks like this. We're gonna take a look at some feature of the market. Now, it might be something like it might be price action. It might be pinch and stretch. It might be support and resistance. It might be price relative to the Bollinger Band mean. We might be looking at volatility. Whatever the particular element of market action that we're looking at, we like to use a statistical treatment. And what we will do is we will take some statistically significant look back period, and it has to be at least 30 days. And so we might use the last 30 days of behavior or the last 30 bars of behavior and apply a statistical test to it and come up with a reading on the indicator on this day, on the 0 day. And then what we're going to do is we're going to put that reading into the statistical context of maybe the last 180 readings, so that we have a lot of data about a 30 period look back. And then what we will do is we will rank those different readings, and we will identify the maximum, the minimum, the average score, and then we'll take the standard deviation of it, which is a measure of variation, and then we will take the average and then add a standard deviation and subtract a standard deviation. And then that actually mathematically is going to represent about 2/3 of the data, because about 1/3 of it falls between average and +1, and 1/3 of it falls between average and -1. And that gives us 2/3 of the readings of that indicator for the last 180 days. And we're going to treat that as a normal condition. And if it's above average, we're going to give it a color code of white. And if it's below average, but within 1 standard deviation, a color code of yellow, warning, alert. But if it's more than 1 standard deviation below the average, it's only going to represent 1/6 of the data, and that's going to be coded red, and that's going to be abnormal bad. And then if it's above one standard deviation above average, it's going to be also 1/6 of the data, and that's going to be abnormally good. And one of the things that we know, whether you're talking about volatility, price action, or whatever, is that extreme results come from abnormal conditions. Like abnormal conditions produce abnormal results. So when we're looking for compound critical states, as we described in the sniper, we want to look for symbols, targets, candidates that are combining multiple abnormalities in their price action because something unusual is going on, and it's more likely to trigger fear and greed, and that's going to produce big moves in either direction, and then the reactions against those moves back towards the mean are also going to be large. So we have a couple bites at the apple on how to trade the larger than normal price action. So one of the features of our meta system, our meta approach, is to use a statistical treatment for all of the indicators that we use to determine when they are truly in abnormal conditions. And we use that to fine tune our understanding of an indicator like the average directional index. Like when we study the statistics of the last 180 days for the S&P, we can actually say that right now 12.8 is the abnormally untrending reading on the ADX. Conventional wisdom is that that's 15. But based on recent statistics, it turns out that you need to see ADX below 12.8 to have a truly abnormally non-trending price action over the last 14 days. And so if you see it go below 12.8 and then come back above 12.8, much like the RSI weekly, you are now starting to see untrending behavior become trending behavior, and then you can see is the price action going up or down, and then that's what the next emerging trend is going to be. Similarly, it takes a reading right now greater than 35 for it to be an abnormally strong trend. So in the travel of ADX from about 12.8 to about 35 today, as we speak, is the range of normal trending behavior. It's not until it gets above 35 that you have unusually strong trending behavior, and you better be prepared for sudden sharp reversals. Now, that number changes through time for the S&P based on how price action has changed, and it's different for every symbol in the market. One of the advantages that you can gain is to be able to take that, what we call the ADX stat or the ADX statistic, and understand what that looks like for each and every symbol of interest that you're specializing in. That's one of the ways that you can get a statistical edge that 99.9% of the traders in the world don't understand. That's an advantage to you. So that's what I want to say in general about market classification and different methods whereby you can fine tune your indicators. And keep in mind this little strategy for longer term, and then this general approach here for shorter term. Now, on our homepage at tortoisecapital.net, we have about a 90-minute lecture on how to read our daily report that goes into great painful detail on how we use traffic lighting and market classification and how to read the report. So I'm not going to repeat that here because it's freely available. But that is worth looking at. And then we have one for about 60 minutes that takes a look at our weekly report, which is more geared towards swing trading, and longer term positions. So the daily report is suited for short-term swings and intraday trading. And those two many lessons are available at tortoisecapital.net. There's also a free lesson where we talk about the NDX indicator. I'm going to give you a brief summary of that right now because we have a little bit of time. It looks something like this. One of the indicators that's available on every trading platform is Williams percent R, created by Larry Williams, genius. What he does is he takes a look at today's price action and then goes back 9 days and finds the highest high and sets that equal to 0, and then the lowest low, including today, and sets that equal to minus 100. And then he says any reading, when this closes right here at like minus 95, if it closes and the reading is below minus 80, then it's oversold. And if it's above minus 20, between 0 and minus 20, it's overbought, and then otherwise it's normal. There's two problems with that. It uses today's current data. So you always get a reading between 0 and 100, but you don't know from the reading if there was a big breakout below the previous low. That's a problem when you're looking at 500 symbols and you're interested in breakdowns. And the second thing is that the readings are not intuitive, because I like to think of this as a thermometer where it's going from 0 to 100. So we created the 10-day index, or NDX, that fixes those problems and gives us a little more actionable information. What we do is we still use a 10-day look back, but we look at yesterday's prices to 10 days, and we don't include today's bar in that reading, because what we want to see is on a scale of between 0 to 100, where did today's close fit on that scale? If it was within the last 10 days trading range, then it's just a normal price action. But if it actually broke down and closed below the previous 10-day low, I want to know that, because that's a signal of something unusual happening, or if it was above, something positive. So if I had 500 symbols in a stack and I ranked it by the NDX, and I took a look at between 0 and 100, this was all the normal price action where things closed within the previous 10-day range. I want to know which are the ones that broke out above 100. And then the size of that number will tell you how far away from the previous range it actually broke. So you could see a number like 300 is better than 101, because that's a huge breakout, whereas a 101 is a small breakout. And similarly, any number below 0 is interesting because this thing is collapsing. So that's an example of one of the things that we talk about in our daily report, and it represents the way that we will create proprietary, unique, personal indicators to tell us what we actually need in order to trade the way we want to trade, about what's important. And the fact that we have personalized and proprietary indicators gives us an advantage to people who are only looking at default indicators, and we can actually exploit their lack of professional tools to our advantage. A deeper discussion of the NDX is contained in that how to read the market reports. The iterative process of reading the reports for continuous improvement. One of the things that we do every night in the nightly strategy podcast is go through the daily, and then the weekends we look at the weekend report, and we connect today's report to tomorrow's trading, and we look at today's trading as a result of yesterday's reports, so that we can see the connection between planning, preparing, executing, and assessing. And so the nightly podcast gives us a way to be prepared for tomorrow, to understand what happened today, to take a look at our internal processes to improve, to engage in public coaching, and to record that so we can come back and study the results when we're doing a deeper dive into process improvement. That's what we mean by the iterative process of reading the reports for continuous improvement. That when you pay attention to those daily tasks of trading, you're just going to get better because that's what happens. I want to say that is really our edge, is by reading those reports and looking for abnormal conditions like breakdowns and indicators and market classifications and statistics, we're finding moments where the fear of maximum pain calms down and gets back into a sideways trading range that compresses. That change in volatility and the ability to measure that in a disciplined, systematic manner is what allows us to be agile and ready for surprising moves, or moves that surprise other people, but which we are prepared for. And then the fact that the compound critical state where range has compressed, in which we do not have a directional bias, allows us to respond to the surprising price movement that catches other people by surprise, but which we are prepared to follow and then get our risk out. That's the secret of sniper trading and most of our swing trading as well. That is a persistent edge. This idea of backing and filling is what happens when you have a tight sideways channel. You get a breakout to a new price level that begins to stall, and then you may see a retracement back to the previous where that breakout fails, or you may see it retrace a little bit while people protect profits, but then resume and break out once more, and then you start getting that Kata 2 style of higher lows and higher highs that give us a directional trend with measurable legs. Statistics help us estimate the size of those moves and to be prepared for them. So this idea of our statistical edge in our planning, preparation, execution, and assessment strategy is one of the ways that we exploit our edge professionally. And so that the key words and concepts: market report to disciplined, systematically approach that market, classification in the many different ways, how we assemble that interpretatively into a market mosaic using indicators like the NDX and some other ones. And then I want to wrap up by talking about a really good strategy, the max pain range compression, which is discussed in detail on pages 205 to 206, and which gets represented by this little diagram here. I want to describe that in the following way. What I really like to see is a market that has been sideways to the point where the Z3 lines have really compressed, abnormally so, and hopefully ending in a little doji. And then what I like to see is some kind of news event, or even if there's no news, it's just surprise that suddenly price breaks out of that range and you get this extraordinary maximum pain. And what we describe as pain is the percentage of price that it has fallen. And if I'm doing swing trades, let's call the 10-day high as a reasonable maximum optimistic moment in the last 10 days. If I go from the close back to 10 days, wherever that 10-day high was, that was the peak of maximum optimism about that particular price. And then what I want to do, and then what I'm going to classify as pain, is that every price action that moves against that is a measurement of pain based on how far it has fallen That's going to feel like a red hot poker. And the percentage that it has fallen is the pain percentage that that guy who bought it, because somebody bought it right here. Some guy bought that because he waited to see enough confirmation, and maybe it broke out from a previous 10-day high, and now he decided to buy it here. And he is the top tick. And then as this continues to fall, he is experiencing more and more pain. One of the things that will happen is that pain will begin to accelerate the size of the bars. And so it's not unusual to see pain start like this and then sell-offs quickly get into what Robert Gardner would call the red Niagara. Beautiful name. And it looks like this giant red bar. Now, this could be multiple bars, but when you have a catastrophic parabolic sell-off, that's just one big pain event that hurts, and the degree to which it hurts is how much pain. And so if I have a stack of symbols that I'm interested in, like the Dow 30 or the S&P 500 or the 200 most liquid ETFs, or all of them in one big list, and if I sort that by percent pain, all I have to do is compute for each one of them the 10-day high minus price, and then express by 100, and that's going to give me a pain percentage. And then I can put the maximum pain at the top, and then that becomes the most important one to trade because that's the one that feels the most pain. So I want you to think of the max pain as the most painful expression of fear. That's maximum negative emotions. But that's not all I want. What I then want to see is range compression. I want to see all of that negative emotion suddenly get converted into the smallest, tightest doji, the smallest amount of range compression, because the movement from maximum pain to range compression of a doji says that I've gone from a state of one-sided negative emotion of fear into a location where the sell-off emotion is being balanced equally by aggressive bullish behavior that's buying that sell-off. And they're engaged in a strict tug of war over a very small piece of terrain. And so the maximum size of this range of sell-off compared to the minimum size of range compression represents a completely new shift in market psychology away from fear to a perfectly balanced fear versus greed. That represents, now if I take for each one of these things that I measure, I take a look at today's range and I simply take the high minus the low and I call that the range compression. I can then do a column of range percentage, and I can divide the amount of pain, the sell-off from the 10-day high, by the size of today's doji, and that's going to give me a ratio of pain over compression. And then the one that has the highest ratio is going to be the best possible reward to risk ratio, because from that doji, what I'm going to do is I'm going to frame a trade that treats this as the indecision zone or my execution risk. And what I'm going to do is I'm going to place a buy order 5 cents above yesterday's high as the first indication that maybe a return all the way up to the 10-day high is underway. It begins with a price action that makes a high that was greater than it could even get to on the range compression day. So this is the first new price that gives me information that a new bullish move might be underway. And if I can take the size of today's range and then count how many of those units of risk are available to the 10-day high, there might be 1, 2, 3, 4, and then I have a 4-to-1 max pain range compression ratio. So if I measure that ratio for all of these and then sort it by the max pain range compression ratio, I can draw the line at 2-to-1 and then take as signals or frames anything that's better than 2-to-1 on the upside. Now, one of the advantages that I have by having no directional bias is that I know that the previous move was a horrible sell-off of large proportions. And I know that if on the day after the doji, that this thing goes below the doji's low, then I'm looking at a resumption of the previous horrible move. So I know that that's going to be a massively good trade to the downside. I don't even have to compute that. But I also just happen to know that it's going to be symmetrical because the size of that sell-off is what gave me the size of the reward to the upside. So if it simply duplicates that same sell-off, leg 2 is the same as leg 1, symmetry, then I'm going to have the same reward to risk ratio on the downside. So all I have to do is formally measure the upside, and then that gives me the same ratio for the downside. So our logic here is that the shift in market psychology from maximum pain to range compression represents a new psychological market condition. It's no longer runaway fear because it compressed into the range, and now it's balanced on this little scale between bulls and bears. And if I turn it sideways, I realize that it looks like this. It's perfectly balanced between bears and bulls. And so as soon if price opens inside this yellow zone and then breaks out north of yesterday's high, I have an automatic mechanical entry. And now I can rank all of my symbols of interest, and let's say I have 50 or 60 of them. If I rank them by max pain range compression ratio, I have an automatically calibrated set of new symbols to be ready to trade tomorrow with a reasonable price target of the 10-day high as my reasonable upside move and a continuation same side move to the downside in case it fails. And now I can engage in what we call swing trading 1 day at a time. And if I just update this list every day, which I can do in a spreadsheet in 2 seconds after the close, I now have the ability to always find the ones that are in the most extreme conditions and be prepared to trade them 1 day at a time. Then if I want to, if that thing moved out nicely, but there's still a distance to go to the 10-day high, I can take a look at the market classification and say, is this the kind of a market in which I have an advantage of holding it overnight? If so, I can convert the 1 day intraday trade, swing trading 1 day at a time, to an overnight trade and keep that momentum going. But if I decide to sell it and it still keeps going up the next day, I can re-enter in a relaxed fashion with a continuation pattern. That's the idea behind the max pain range compression. If there was only one strategy that I was going to go to sleep on and wake up in 30 years and expect it to still be working, it's max pain range compression. It is the central core concept behind most of our swing trades, which are more detailed explorations of that same idea. But if you're looking for the absolute core idea behind swing trading, it's finding the anomalies of unusually large sell-offs and unusually large or small range compressions to set up a compound critical state where you are prepared to trade it in either direction without bias or forecasting or prediction. You're simply responding and following and adapting to price action. So that's what I want to say about max pain range compression. And we'll finish up by simply acknowledging some of Griff's synthesis, where for longer term trading, he knows that he wants to look more at the weekly RSI 14 because it will also help with the reversion to mean trades that they're studying with Edge Rater and statistics. And it may also be of use when we take a look at our ongoing research project about the regression line 30 slope. When it sells off more than 2 standard deviations, we know that we have an extreme condition as well. And so it may be that the combination of those two gives us additional insights. That's an ongoing research project. And so that's what we're looking at in our action statement as well. So this is where we've been today. We've taken a look at market reports, market classification, the idea of a mosaic approach to understanding many different independent indicators. We've taken a look at some ideas behind one indicator and how it comes about. We've taken a look at a strategy for deepening our understanding of standard available default indicators, that if you start applying that traffic lighting to standard indicators, you'll have a better understanding of that indicator than 99.5% of the people who only use the defaults. Statistics is an edge, and that can be applied in swing trading one day at a time. This actually works intraday too, if you're looking at big sell-offs intraday and you're working on 3-minute charts. And then for longer term swing and core trading, the idea of our market classification will always help you. I'm going to come back to our 2 traders, Jeff and Ernie, and give them tons of respect for the bravery and courage to explore their trading lessons in public, in accountability groups, and the power of journaling when it comes to accelerating your own rate of professional learning. So that's everything I want to say there. And I want to say thanks for your kind attention. Got about 5 minutes if there's any follow-up questions on any of tonight's material before we hang it up. So if you have one, go ahead, come online with your headphones and send it, and I'll see if I can get through in a couple minutes. Remember, if something does occur to you, you can just send it to me by email, and I'm happy to add those to the list of things to discuss. So hearing no questions and seeing none in the chat, I'm going to say thanks for your kind attention. We'll get this published and posted in the usual spot in the online work area. So thanks a lot. Keep up your reading and studies. Keep sending me your questions, and we'll see you soon. Take good care.